look from down here, 3 a.m., I mean, it's a pretty clear trend, right? It'd be tough to miss this one. You can see it was rising a little higher, sagged down, but some easy trend there. And looking back, you see that. So one of the things that you'll see, and I do some stuff on traps, although it's not something you can necessarily trade off of if you don't see a signal. Okay, and we didn't have an entry signal. Sometimes there's a real clear entry signal. What happens, and again, there could be 1,000 explanations for this, but what I usually think is going on here is you have a bunch of people kind of posturing to get in based on the fact they think it's going to be an up day, or whatever the reason is. I mean, it could be a down day and it could be a reverse. It could be a shake up. That's what they call the other one. But you'll see kind of a strong trend, usually moving in one direction or the other. Okay, and then somewhere along the line, the bottom drops out of the market for no apparent reason. Okay, and that's in a shakeout. Okay, and big sell off, and then it gets down to a certain point and reverses. And my take on this is it's the institutional traders or people that have huge volumes to move. They can actually handle this on a very, very large scale. So and an individual can't start a shakeout. I mean, if you look at the volume here, we're talking about 9,700 contracts, 9,300 contracts, 6,000 contracts. It's not going to be something that an individual could ever do. But a good size institution can move thousands of contracts. So let's just say they see this, okay? And you got a lot of traders buying in, thinking that it's going to be a strong up day, okay? And all those traders are going to put stops in because that's what they teach you, okay? Buy into a position and put a protective stop down below you. Okay, so let me bring over a dome. Okay, and let me enlarge this a little bit more so we can see it. Okay, and so let's say I go long. Okay, what do I get? 2 contracts. Okay, so I'm 2 contracts long at somewhere around just under 4,200. Okay, and so if I want to protect myself, okay, I can put in a protective stop down here. Okay, and I can go away. And I have 10 points, well, 9 or 8 points because it's all my dome has, but I could put the stop in anywhere. I just wanted to show you. And if the price gets down to that point, it's going to take me out. So the maximum loss is 10 points, and maybe that's what I can handle on my position. Okay, is 10 points. Okay, now these people, they may not have a strategy. Okay, all they may have is an idea that the market's going to go up and they want to buy into it and they want to protect themselves if it doesn't go too far. So basically they're just gambling. Okay, so now you sit around and you wait, or you go do your laundry, or you go play a game of golf, or you go skiing, and you hope for the best. And you might have an out way up high. But on the other hand, maybe you don't. Maybe you just figure you come back this afternoon and, hopefully it'll be up, 4,300 or 4,400 and you'll have gotten rich. Okay, and that's your play. So if you look here and you see this protective stop, it does what's called, it puts these numbers in here, okay, on your dome, on depth of market. Okay, in level 2 data it's called. And there's a whole story behind that too, but just so you understand, everybody can see these orders sitting there. They're all visible. Okay, and if you have level 2 or even level 3 data, if you have level 1, you're not gonna see it. But most institutions are gonna be able to spot a large number of stop orders sitting up there. Okay, and so all they have to do is start selling contracts. Now, that sounds easy, right? Just sell a few contracts. Well, no, they literally have to sell, in this case, it's 9,000 contracts, all short, to get this thing to move down. Okay? And then there's like a stop here, and then another 9,000 contracts. And it probably wasn't that many. I mean, it's 9,300. So my guess is that, there's probably a 50-50 split in any given bar. So 4,500 and 4,500. So if they just outweigh one side, so maybe throw a couple thousand short, it's going to start moving it down. Okay, and then here a bunch of long players came in and tried to push it back up, but it didn't really do much. And then they probably threw in another couple thousand here. So they might have 4,000 short contracts, okay, that they purchased all the way moving down. And eventually, those stops are going to start getting hit because nobody puts stops 50 points below. They put stops 5 and 10 points below. Okay, they want to protect themselves, not cost themselves a fortune. So as the price moves down, because of these institutions selling, you're going to get the stops from the retail traders getting hit, and you're going to get kind of an avalanche effect. And it's going to be more selling, and the price is just going to keep moving down, 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 down. Okay? And these people are selling to get out of positions. Remember that. The retail traders are selling to get out of positions. That's how they're closing out their positions. The institutions are selling and acquiring positions, but they're still driving the market down. So now when the market gets down to here, and remember the last part of the move is probably all the retail traders selling out of their positions, okay, losing money. Now the institutions are going to flip around, okay, and they're going to start buying strong. Okay, they got in short up here, they start buying up here, down here, and they've made money on that. Maybe not a lot of money, but they made money. Okay, they sold all the way down, so in here they probably have some very small profits, but when they start buying, they're going to be the first ones in the reversal, and they're going to do the exact opposite in huge numbers, and it's going to force the price back up, and then they're going to hit it again and force the price back up again. Okay, and they're going to make money as the price starts going back up. These guys that lost all their money over here are probably just snapping out of the fact that they thought they were going to have an up day and make some money, and they lost 10 or 15 points or whatever. Okay, and as this goes up, 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 then they start buying back in. But they're too late. The price is already back in here. Okay, and maybe they'll make a little bit of money on this. They might even make their 10 or 20 points back. Okay, probably not. Usually they get nailed again in some other form. But that's kind of the idea behind the shakeout. That's kind of what's going on there. The institutions are controlling this and manipulating the market, and they're knocking the retail traders out because they can't hold their positions. Either they get called, their margin gets called, or they have stops. One way or the other, they get knocked out. Okay, one of the things that you'll see is this up and down pattern, but you also see the trend continue. That's usually very, very common in a shakeout. The trend continues exactly the way it was, but it knocks all the weak players out of the game, and that's what you see down here. Okay, so that's a shakeout.